While the world is distracted by daily headlines, millions of ounces of physical silver are quietly being drained from global vaults at a record pace. This isn't just market volatility, it's a massive structural crack in the global financial system. If you're invested in real assets, or even if you're following the Iraqi Dinar space, you need to understand that the gap between paper promises and physical reality is reaching a breaking point. Today, we're going behind the charts to reveal what's really happening under the surface of the silver market and why a major shift in wealth is already underway. Let's dive in. Over the past several days, I've been watching silver move in a way that tells a much bigger story than just price action on a screen. What we're witnessing right now isn't random volatility or speculative noise. It's a reflection of deeper structural stress building underneath the global financial system. And if you're following the Iraqi Dinar space, understanding these shifts in real assets like silver matters more than most people realize. Recently, silver pushed upward exactly along the kind of trajectory that short-term market structure had been hinting at. After trading in the mid-70s, it moved higher toward the upper 70s before pulling back slightly and stabilizing again. That kind of movement might look like routine market fluctuation to casual observers, but to experienced eyes, it signals something else: the growing tension between paper pricing mechanisms and physical supply realities. While prices were adjusting, physical silver inventories were quietly being drained at a pace that's becoming difficult to ignore. Millions of ounces were withdrawn from major vault systems in a very short time. Registered inventories, the metal actually available to settle futures contracts, dropped below critical psychological thresholds, landing under 90 million ounces. That might sound like a large number, but in the context of global demand and derivatives exposure, it's surprisingly tight. What makes this especially important is that withdrawals weren't isolated to one location. Multiple vault systems saw metal leave simultaneously. This wasn't a simple reshuffling from one category to another. It was physical removal. When metal exits the system rather than being relabeled, it reduces the cushion that supports paper market confidence. At the same time, something significant has been unfolding in Asia. A major shift in trading rules is set to reshape how near-term silver contracts are handled in one of the world's largest commodity markets. These changes effectively restrict speculative positioning near delivery periods unless specific approvals are granted. In plain English, this move prioritizes real industrial demand over financial speculation. Why would such a change be introduced? Because physical inventories have dropped sharply, by nearly 90% from previous peaks in recent years. When stockpiles fall to those levels, the priority shifts from price discovery to supply security. Nearby contracts trading at higher prices than longer-dated ones, a condition known as backwardation, reinforce the message that immediate access to metal is becoming more valuable than future promises. This represents a subtle but powerful shift in control. For decades, paper trading has heavily influenced commodity pricing. Now, physical realities are beginning to assert themselves again. As nations move to protect domestic supply chains, the balance between financial instruments and tangible assets starts to tilt. Adding another layer to the story is emerging policy direction in the United States aimed at protecting the pricing stability of critical minerals. Details suggest a mechanism that would prevent strategic resources from being driven below production costs through speculative pressure. If implemented fully, that kind of structure changes the game, because it weakens one of the traditional tools used to suppress commodity prices during periods of financial stress. Markets responded quickly to the possibility of such support. Silver rebounded sharply from recent lows as the implications became clearer. For years, sudden downward price moves were almost routine, often appearing at predictable times during trading sessions. Recently, the absence of those familiar declines has stood out just as much as the rallies themselves. Monetary policy expectations are also playing a role. Signals from the Federal Reserve suggest that interest interest rate reductions could become appropriate if inflation continues its gradual descent. Even cautious optimism in that direction tends to support hard assets, because lower rates reduce the opportunity cost of holding them. Meanwhile, geopolitical tensions are simmering in the background. Rising strain in the Middle East has already pushed oil prices higher. The strategic importance of energy corridors means any disruption could send ripple effects through global supply chains. With a significant portion of the world's oil flowing through narrow maritime choke points, even the perception of risk is enough to move markets. But perhaps the most profound pressure isn't geopolitical, it's fiscal. Long-term projections indicate that U.S. debt could surge dramatically over the next decade, climbing toward levels that would eclipse historical records set during wartime, but this time occurring in peacetime. Annual deficits are expected to expand steadily, while interest payments alone may soon consume an enormous share of government revenue. That creates a feedback loop. As borrowing rises, interest costs grow. As interest costs grow, borrowing must increase further to sustain spending. Eventually, confidence in purely financial promises begins to erode. This is where broader global sentiment comes into play. According to measures compiled by the International Monetary Fund, uncertainty across the world economy has reached unprecedented levels. This index tracks how frequently instability and unpredictability are discussed in economic analysis across dozens of countries. Today's readings exceed those recorded during the global financial crisis, the pandemic era, and even earlier technological bubbles. When uncertainty reaches such extremes, businesses pause. Hiring slows, expansion plans are delayed, capital investment is postponed, liquidity becomes defensive rather than productive. In that environment, tangible assets historically begin to move from the margins of portfolios toward the center. Yet here's the paradox: despite all the structural stress, silver remains dramatically underowned on a global scale. The proportion of total wealth allocated to silver today is a fraction of what it was during previous periods of financial anxiety. That suggests we're not looking at an overcrowded trade or speculative mania. Instead, we're seeing neglect. At the same time, relative valuation between gold and silver continues to draw attention. With gold hovering near major milestones and silver still significantly below levels seen in previous cycles, the ratio between the two metals implies that silver may have room to adjust if historical relationships reassert themselves. As we approach key settlement periods in futures markets, the tension between available physical supply and outstanding contract commitments is becoming more visible. Open interest remains substantial, and not all positions have been rolled forward. That increases delivery pressure as deadlines approach. Of course, no scenario is one-directional. There are potential counterforces that could ease momentum. Geopolitical tensions could cool. Policy shifts might take longer than expected to materialize. Monetary easing could be delayed if inflation proves stubborn. Institutional capital might remain focused on technology sectors rather than rotating into commodities. But even with those caveats, the broader picture is difficult to ignore. We're seeing declining inventories, policy adjustments favoring real supply, growing fiscal strain, elevated global uncertainty, and continued underallocation to physical assets, all converging at the same time. For those watching currency dynamics, including Iraqi Dinar observers, this matters because the same forces influencing metals often signal underlying shifts in trust toward fiat systems. When confidence in paper structures weakens, the ripple effects extend far beyond commodity charts. The takeaway here isn't about chasing price or predicting exact moves. It's about recognizing that markets are increasingly reflecting deeper realities rather than surface-level speculation. Silver's recent behavior isn't just about short-term volatility. It's a window into how the financial system is adapting to scarcity, debt expansion, geopolitical tension, and uncertainty. And when real assets begin to speak louder than financial abstractions, it usually signals that something larger is unfolding beneath the surface. While the world is distracted by daily headlines, millions of ounces of physical silver are quietly being drained from global vaults at a record pace. This isn't just market volatility, it's a massive structural crack in the global financial system. If you're invested in real assets, or even if you're following the Iraqi Dinar space, you need to understand that the gap between paper promises and physical reality is reaching a breaking point. Today, we're going behind the charts to reveal what's really happening under the surface of the silver market and why a major shift in wealth is already underway. Let's dive in.